Can the outcome of a presidential election predict what happens in the stock market? Since 1953, stocks have gained 11% on average with a Democrat in the White House compared to 6.5% with a Republican. Of course, that could just be correlation, not causation. But can the stock market predict who wins the race for president? When Bill Clinton first ran for president, his campaign famously said, "It's the economy, stupid." And it worked. However, presidents have very limited influence over the state of the US and global economies, even though presidents do get the credit or the blame for the state of the economy during their term. Consider the wealth effect, which causes people to feel like they've gotten more money when the value of their assets rise, such as their homes and stock portfolios. Even though their actual income hasn't changed, they're happier, more optimistic, and more willing to spend. Naturally, they want things to stay unchanged so that the good times keep rolling. But when the bottom drops out of the economy, voters want change. Even if the current president didn't cause the economic turmoil, he or she also didn't do anything to fix it. As a result, voters look at the choices on the ballot and say, "Next." It's a nice theory, but is there any data to back it up? A number of analysts have crunched the numbers, and the math shows that if stocks drop when you're the president, voters will likely drop you. But if people feel good about their finances during your term, you've got a better shot at staying in the Oval Office. The Dow Jones Industrial Average is a surprisingly reliable election predictor, according to MarketWatch columnist Mark Hulbert. Going back to 1896, the year the Dow Jones Industrial Average was created, Hulbert divided presidential elections into 4 groups based on the index's year-to-date return on election day. What he found is that the worse the market performed on any given election year, the less likely the incumbent party would be to win the White House. The group of election years with the best stock market returns showed a nearly 90% chance that the incumbent party would win. The second highest group gave the incumbents a nearly 70% chance. The second worst group dropped the incumbents' chances to slightly better than 40%, and the worst group put the odds in the high 30s range. Turning to a different index, an analysis by LPL Financial found that the performance of the S&P 500 index has accurately predicted the presidential election outcome 83% of the time in 20 of the last 24 elections. This analysis found that since 1928, a positive S&P 500 during the 3 months leading up to an election indicates that the incumbent will stay in the White House 80% of the time. A lower market in the 90 days before an election resulted in the incumbent party losing the presidency 8 out of the last 9 times. The S&P 500 posted new record highs this year, which according to the analysis should bode well for the Democrats. But it's important to note, while there's been a strong correlation between stocks and the presidential election, no analysis has been correct 100% of the time. And if you want more content like this from MarketWatch and the Explainomics playlist, please subscribe and keep checking back for new videos. And we'll see you next time.